Welcome to The Explainer. We're jumping right into one of the most chilling economic warnings we've heard in recent memory. In late 2025, Ray Dalio, the founder of the world's largest hedge fund, spoke up about his proprietary bubble indicator that actually dates all the way back to 1900. And right around that same time, journalist Andrew Ross Sorkin published a best-selling book titled simply 1929. What the data showed? Absolutely staggering. Dalio's indicator was flashing at levels seen only twice in an entire century, 1929 and 2000. In a CNBC interview, he literally estimated that the US market is roughly 80% of the way into a full-blown bubble. And it wasn't just him. The governor of the Bank of England publicly compared the current AI boom to the historic run-ups of 1929, 1973, and 2007. Suddenly, the entire financial world is whispering the exact same terrifying thing.
So, is this 1929 again? I mean, it's a massive, heavy question. But to answer it honestly and without just fear-mongering, we can't rely on that black and white newsreel version of history we all know. We actually have to treat 1929 like a crime scene. We need to investigate the actual machinery underneath the myths. And to do that, we need to meet the mastermind of our historical detective story. A trader so incredibly skilled that during a previous panic, J.P. Morgan himself actually sent word asking him to please stop shorting the market. This guy cracked the code, bet against the machinery in 1929, and walked away with a fortune worth roughly $1.7 billion in today's dollars. His story contains a massive warning for us today. Okay, let's dive right into Section 1, the gravity of leverage.
Let's look at our first major piece of evidence. It's the seductive invention that totally fueled the 1920s market, buying on margin. If you wanted $1,000 of stock back then, you didn't need $1,000. You could put down as little as $100, and your broker lent you the rest. Now this acts as a curvature amplifier. It bends gentle market ripples into extremely steep cliffs on your personal account. If the stock rises 10%, boom, your money doubles. But if it falls 10%, you are completely wiped out.
And here's where the machinery turns incredibly deadly. When you're wiped out, your broker doesn't just wait around. They sell your shares by force before you hit zero. And this creates a terrifying doom loop. Prices fall, margin calls trigger, forced sales push those prices even lower, which, you guessed it, triggers more margin calls. Forced selling actually turns a decline into the literal cause of further decline. It proves that on the way up, leverage is a nice tailwind, but on the way down, leverage is literally gravity. To really wrap your head around the sheer scale of this, look at this number. By autumn 1929, brokers' loans reached $8.5 billion, guys. That was more than all the physical currency circulating in the US at the time. It's wild. The interest rate on this borrowed money spiked as high as 20%, and people just kept borrowing anyway. The market was essentially a giant tower paying its own interest bills right out of its own rise. Which brings us to Section 2, the trap, and how the economy turned before the market did. You see, the most tragic character in this whole story isn't the ruined investor. It's actually the Federal Reserve. They kept interest rates really low as a gift to help Europe cling to the gold standard. But that cheap money became absolute rocket fuel for Wall Street. By the time they gingerly tried to raise rates to cool things down, they walked into a total trap. Rates were high enough to tip the real economy into recession by August 1929, but the Dow didn't actually peak until September. So the crucial point is, the factories cooled before the ticker did. And from that peak, the Dow fell 89% and didn't see that high again until November 1954. To put that in perspective, a 30-year-old who bought the top finally got his money back at age 55.
All right, Section 3, how to spot a top. Let me introduce you to Jesse Livermore, the 52-year-old trader who executed the most famous short in history. Now, there's this massive myth out there that he magically predicted the exact top of the market. The reality is quite the opposite. In the summer of 1929, he definitely grew suspicious. But instead of shouting that a crash was coming, he just placed small probe trades. These were little short positions just to test the waters. When the market kept rising, those probes lost money, and he just cut them without any drama. To him, that wasn't a failure at all. That was simply paying the market for information. And this brilliantly illustrates his true method. He didn't just stare at the overall index, he watched the market internals. By late summer, he noticed a really critical divergence. The overall index was still hitting new highs, but the leading stocks, the generals of the bull market, kept failing at theirs. As the saying goes, the army was still marching, but the flag bearers were falling.
Price flows like water, and Livermore saw that the line of least resistance had officially changed direction.
Moving right along into Section 4, Spark versus the Dynamite. Let's pivot to a huge misconception right now. The stock market crash did not actually cause the Great Depression. Think about it. In 1987, the market fell 22% in a single day, and there wasn't even a recession. The 1929 crash was merely the spark. What turned it into a decade of sheer misery was the dynamite underneath. First off, the money supply collapsed by a third, as credit totally froze. Second, 9,000 banks failed. And remember, with absolutely no deposit insurance back then, just a rumor could kill a totally healthy bank. Third, the gold standard acted as these golden handcuffs, preventing central banks from printing money to rescue the economy. And finally, the Smoot-Hawley tariffs sparked a massive trade war that shrank world trade by more than half.
Woven through all of this was a concept the economist John Kenneth Galbraith called the bezel. This is essentially the inventory of embezzlement and hidden fraud that just silently grows during every bull market. Because, when every number is going up, nobody audits anything. A bear market is really simply Judgment Day, when those hidden frauds finally detonate one by one, deepening the panic. The reality is, every long boom builds its very own bezel.
So that brings us to Section 5, 1929, 1999, or today. Are we facing 1929, the dot-com bubble of 1999, or something else entirely? Well, the Bank of England actually has a brilliant framework to figure this out. Track where the leverage is hiding. See, 1929 was a credit finance bubble. It ran on borrowed money threaded right through the banking system. So when it popped, it destroyed the money supply itself. 1999, on the other hand, was largely an equity-financed bubble. Trillions vanished on paper, for sure, but the banks stayed solvent and the resulting recession was pretty mild. Today, it's kind of mixed. Households are definitely less margined than they were in 1929. But as this massive AI build-out gets increasingly funded with corporate bonds and private credit rather than cash, that highly dangerous 1929 wiring is slowly creeping back into the picture. But there is a very modern twist here that changes the ending entirely, exactly as Ray Dalio points out. Back in 1929, the dangerous debt sat squarely in the private sector. Today, the most indebted actor by far is the government. And a government in debt doesn't just liquidate like a margin account, it prints. What this means is that if a crash does come, we might not see a 1929-style deflation where cash is king. Instead, asset prices might be propped up nominally, while the money itself just quietly loses value. So what should you really take away from all this? Well, we've uncovered 3 historical laws that you can use to evaluate literally any market environment. First, leverage changes your geometry, turning gentle slopes into sheer cliffs through forced selling. Second, the real economy turns first. The market leaders stumble long before the index admits the truth. And third, the depth of any collapse is determined by the plumbing underneath, like the banks and the monetary system, not the initial spark of the stock market falling. But there is one final, really tragic epilogue that outranks absolutely everything we've talked about. Jesse Livermore, the man who brilliantly beat the 1929 crash and made nearly $2 billion in today's money, he was completely bankrupt by 1934. His methods were mathematically flawless, but he lacked a system for governing his own psychology after the big win. It proves that making money and keeping money are 2 completely different skills, and history ultimately grades you on keeping it. History never exactly repeats its prices, right? But it always repeats its causal structure. The geometric forces of leverage, human greed, and economic gravity simply haven't changed in a century. So as you look at the debt fueling today's biggest technological booms, I really want to leave you with one vital question to ponder as you navigate your own investments. Which year are you truly carrying the risk for right now? Is it 1999, 1999, or neither?